You probably already have heard about the trigger rate that everyone is talking about and how it will affect a lot of borrowers after September 7th rate increase announcement. But do you understand what trigger rate is and how it will affect you? And most importantly, what do you do if that happens to you? We're going to talk about this in today's video. At the end, I will provide a few very important tips on what to do if you happen to hit that trigger rate, and make sure you discuss those with your lender as soon as possible, as we are less than a week away from that next announcement. So make sure you stay until the end, and if you have any questions about anything I mentioned today in today's video, as always, just reach out to me. My contact information is right under this video, or just comment below and I'll make sure you get that answer. Welcome back to my channel. My name is Marina.selby and I'm your local real estate agent servicing GTA, and on this channel we talk all things real estate. If anything this past couple of years taught us is that the predictions and forecasts are almost always wrong. The official sources predicted at the very beginning of this year that the upcoming rate hikes would not affect the housing market due to many internal and external factors, as well as the big six banks were predicting the overnight rate to increase by 1% overall by the end of the 2022 in the form of 4-point strikes throughout the year, which would have been great if that happened, but in reality, we see a completely different picture. The Bank of Canada's approach when it comes to the interest rate hikes have been quite aggressive lately. The rate hike started in March of 2022, then it happened again in April, then in June, and the biggest one that no one expected happened in July when the rates went up by the whole 1%. This aggressive pace of rate increase is accelerated due to the high inflation rate, which is around 7.6% right now, and the banks are actually forced to increase the rates, trying to lower the inflation rate as fast as possible, and this is their way to mitigate that. Now, the next rate increase announcement is expected to happen next week on September 7th, and there are a lot of speculations going on predicting the increase to be anywhere between 0.5 to 0.75% again, which would be the fourth oversized rate increase this year, bringing the policy rate to 3.25%. The obvious question that everyone is asking, when is it going to end? And when is the last increase going to happen before we start to see the changes? And the answer, to be honest with you, is all over the place. I hear a lot of banks, such as like CIBC, for example, talking about this upcoming increase to be the very last one, while the others don't agree with that, predicting that the rate hikes will continue to increase until the early next year, with the target rate reaching 3.5 to 3.75% from 2.5% that we are in right now, so that's quite a jump. I also hear that some of the other lenders, such as government-sponsored lenders, are forecasting the retraction of this rate as early as next year. So as you see, it's all over the place, and going back to what we have started this video with, don't rely on predictions much, but always closely pay attention to the market conditions and its changes to your best ability, and always prepare, I hate to say that, to the worst, so that if and when it happens, you're not caught off guard and are prepared. So it's safe to say that the inflation rate is a deciding factor on how much the interest rates are going to increase. The ideal inflation is around 2%. That's what they're all aiming for, and until they see it starts to come down, the interest rates will continue rising. So in simple words, the idea is to increase the interest rate to the point that it calms down the inflation, and this is when we start to see the changes in the borrowing costs as the rates are going to start to drop down. Now let's talk about what does that mean to you as a homeowner, and how is the September 7th rate increase next week is going to affect you. First of all, it depends on what type of mortgage and what kind of lender you chose when you purchased your property, as there are so many different types of mortgages and conditions each single lender offers. As an example, if you have a fixed mortgage rate, your monthly payments should not be affected by those increases because you have locked your rate from the very beginning. I know that many of my clients chose a fixed rate at the very beginning of this year when the rates just started to climb up, and we started to predict the rate hikes to continue. So those who felt that it was best for them to get a fixed rate mortgage to have steady payments each month should be in a slightly better position right now than the others who are with a variable rate. Now, those who went with a variable rate are being affected the most by each single rate increase that has been happening, unfortunately. Important to note that those with the smaller mortgages would not be impacted that much by increasing interest rates just because they have equity built up in their homes and they have more options to help them handle those changes and mitigate them. But those with the larger mortgages, such as especially new homeowners, unfortunately will feel the pressure the most because of their larger mortgages. You probably have already heard about the trigger rate that everyone is talking about and how it will affect a lot of borrowers after September 7th announcement. So what is the trigger rate and who are those borrowers that would be affected? And because definitely not everyone. Again, it goes back to the lender, what kind of lender and what kind of conditions you have with them. Those who went with a static mortgage will be affected the most. When you have static mortgage, that means that your monthly payments don't change as the Bank of Canada increases the benchmark lending rate. Instead, the ratio of the principal and the interest that you pay on a monthly basis gets adjusted and going more towards the interest, which means that amortization, the amount of years you have left to pay that mortgage back, increases as well. As the rates climb up more and more, your interest payments increases to the point that it exceeds your total payments. So you technically are now not making enough payments per month, and now you're forced to choose one of the three options that I'm gonna mention in just a moment. But first, let's figure out how to calculate your trigger rate. There's a simple formula to calculate your trigger rate. You need to take your monthly payments and you need to time it by the number of payments you make per year and divide it by the balance owing times 100. Let's look at the example. For example, your bi-weekly payments are 1,100 for the sake of calculating. So 1,100 times 26, because there's 26 payments you have to make per year if it's a bi-weekly, and then you divide it by 480,000, what's left on your mortgage right now, and then you time it by 100. You get 5.96%. This is your trigger rate. Now, obviously, for a more accurate number, you always have to contact your mortgage lender. They will be able to calculate your current trigger rate, so you will know how much breathing room you have and what happens after you hit your trigger rate. As I mentioned, once you reach your own trigger rate, you basically will have three main options to choose from. Let's talk about them. Number one option is to convert to the fixed rate, which is definitely something to think about because at this point it may not be the best option right now, not only because of all the penalties you have to pay to the lender for breaking your existing mortgage, but also overall, on the long run, the rate will be much higher, and if the rates drop later next year or even the year after, you would be stuck with a very high rate locked in for a certain amount of years, and breaking that may cost you thousands and thousands of dollars. I probably would not recommend that, but again, speak with your mortgage professional. Number two, you can also speak with your lender and see if you can extend your amortization period by another 5 years or so. Especially, it's a great option for those who have some equity in their home. This way you keep your payments the same, but if you don't have this option and if you have maxed out your amortization period that is allowed, then unfortunately you'll have no other choice but to increase your monthly payment. And number three, you can also make a lump sum payment towards your principal. And if your lender, of course, allows that, most of them do, but just double check. But this way you can increase your principal payment and hence you push your trigger rate higher. Again, check with your lender if this is something that is allowed. Most of them allow that, but just double check. And just overall, it's always best to obviously speak with your mortgage professional. That will help you understand what is the best option for you. And if you don't have one, I have a team of experts that I work with on a daily basis. So just reach out to me. My contact information is right under this video, and I will definitely connect you with them. Also, in the description below, you will find a link to our new Facebook group that I opened together with my amazing business partners, providing answers to all your questions in regards to real estate transactions, lending, home inspection, and real estate law. We are here to help you and keep you up to date on all the changes that are happening to the housing market and share information, important information with you on how to maintain your property, prepare you for your next purchase or sale, and everything in between. We are super excited to have you there, so please come and join our growing community. Please like this video if you found it useful, as it will definitely help my channel grow, and consider subscribing if you like my content, not to miss the next videos. Thank you so much for watching, and I will see you next time or in my group.